Within hours of military escalation between the United States and Iran, oil markets don't wait. Prices jump. Investors panic. Gas stations react. But why does this happen so fast? The missiles don't have to land for the price of oil to explode. Sometimes the market reacts before the first explosion is even confirmed. A headline appears. A radar blip is reported. A military base somewhere in the Middle East goes on high alert. And within minutes, traders in New York, London, and Singapore start buying oil like the world is about to run out of it. Prices jump. 5%, 10%, sometimes more. Nothing physical has changed yet. The pipelines are still running. The tankers are still moving. The wells are still pumping. But the fear has already arrived. And fear in financial markets travels faster than oil ever could. Because when war starts, oil is not just a commodity anymore. It becomes the heartbeat of the entire global economy. Every airplane ticket, every shipping container, every plastic product, every grocery delivery truck, all of it is connected to the price of a barrel of crude. Which means when oil spikes, the shock doesn't stay in the oil market. It spreads through everything. And that's the strange part. Most people think wars are fought with weapons. But the real damage often shows up somewhere else entirely. In gas stations, airline tickets, food prices, and the quiet math of inflation. To understand why this happens, you have to understand how fragile the oil system really is. Because despite all the talk about renewable energy, electric cars, and green transitions, the modern economy still runs on oil. About 100 million barrels of it are consumed every single day. That oil moves through a massive, delicate network of wells, pipelines, shipping routes, refineries, and storage facilities. It crosses oceans in giant tankers. It flows through narrow waterways. It moves across continents in pipelines that stretch for thousands of miles. And here's the uncomfortable truth. A huge portion of that oil travels through just a few geographic choke points. Places where the global energy system becomes surprisingly fragile. One of the most important of those choke points is the Strait of Hormuz. It's a narrow stretch of water between the Persian Gulf and the open ocean. At its tightest point, it's only about 20 miles wide. Yet nearly a fifth of the world's oil supply passes through it every single day. Tankers carrying crude from Saudi Arabia, the United Arab Emirates, Kuwait, and other producers all squeeze through this narrow corridor on their way to the rest of the world. So when conflict breaks out involving Iran, investors immediately start asking one terrifying question. What if that passage closes? Even if it never actually happens, the possibility alone is enough to shake markets. Because oil traders don't wait for shortages to occur. They react to the risk of shortages. And that's where the price spike really begins. In financial markets, oil isn't just traded as physical barrels. It's traded as contracts, futures agreements, financial bets on what oil will cost weeks or months from now. When geopolitical tension rises, those bets change instantly. Traders assume the worst. Supply disruptions, shipping delays, insurance costs for tankers skyrocketing, military threats to infrastructure. Suddenly everyone wants to secure oil before the crisis deepens. That rush to buy pushes prices up. And the increase can be dramatic. During past conflicts in the Middle East, oil prices have jumped 10% or more in a single day. Not because supply vanished overnight, but because uncertainty suddenly became expensive. Markets hate uncertainty. They respond by pricing in a fear premium. It's a strange phenomenon. The world might still have plenty of oil flowing, but the market behaves as if a shortage could appear tomorrow. And sometimes that fear becomes reality. War can disrupt production fields, damage pipelines, or threaten shipping routes. Even rumors of attacks on refineries or export terminals can trigger waves of speculation. Insurance companies raise the cost of protecting oil tankers traveling through risky regions. Shipping companies reroute vessels to avoid danger. Delivery times stretch longer. Every step in the system becomes slightly slower, slightly more expensive. And those small changes ripple outward through the entire economy. Because oil doesn't stay in the oil market. It flows into everything. Start with transportation. Airlines run on jet fuel. Cargo ships burn massive amounts of fuel oil. Trucks that move goods across highways depend on diesel. When crude prices rise, fuel prices follow. Suddenly moving anything anywhere becomes more expensive. Companies don't absorb that cost quietly. They pass it along, which means the price of delivering groceries increases. The cost of importing electronics rises. Manufacturing expenses climb. And before long, inflation begins to creep upward. That's when the situation starts to worry central banks. In the United States, the Federal Reserve constantly monitors inflation data. When energy prices spike, inflation tends to follow. Higher oil prices can push up everything from transportation costs to heating bills. And when inflation rises, central banks face a difficult choice. If they lower interest rates to stimulate the economy, inflation could spiral higher. If they keep interest rates elevated to control inflation, economic growth can slow down. So a conflict thousands of miles away can quietly influence decisions that affect mortgages, credit cards, and business loans across the entire country. This is why markets watch geopolitical tensions so closely. Not because traders are obsessed with politics, but because oil connects geopolitics to economics. And the effects don't hit every country equally. Some nations actually benefit from higher oil prices. Large oil exporters suddenly earn more revenue for every barrel they sell. Governments in energy-producing regions often see their budgets improve when prices rise. For countries like Saudi Arabia, higher prices can generate massive additional income. But for countries that rely heavily on imported energy, the story looks very different. Rising oil prices drain money from their economies. Businesses face higher operating costs. Consumers pay more at the pump. Trade balances worsen. And when energy costs surge too quickly, entire economies can slow down. History shows this pattern repeating again and again. The oil shocks of the 1970s triggered severe inflation and economic stagnation across much of the world. Energy shortages reshaped global politics and forced governments to rethink energy security. Even decades later, the basic vulnerability remains. The global economy still depends on stable energy flows, which means when war threatens those flows, markets react immediately. Sometimes the reaction overshoots reality. Traders panic. Prices spike beyond what supply disruptions justify. But markets often operate on psychology as much as physical supply. Fear spreads quickly in trading floors and computer algorithms alike. And once prices start climbing, the movement feeds on itself. Momentum traders jump in. Hedge funds pile on. Automated systems trigger additional buying based on volatility signals. The price surge becomes a feedback loop, until eventually reality catches up. Either the crisis fades and prices fall back down, or the disruption proves real, and the spike becomes the new normal. But by that point, the economic damage may already be spreading. Consumers notice it first at the gas station. A few extra dollars to fill the tank. Then airlines adjust ticket prices. Shipping companies increase freight costs. Food companies quietly raise prices. And within months, a conflict that started as a geopolitical event begins appearing in economic statistics. Inflation ticks upward. Consumer confidence drops. Businesses delay investments. It's a slow ripple that moves from oil markets into everyday life, all triggered by the possibility that the world's most important fuel might suddenly become harder to move. Which brings us back to that strange moment when the first headlines appear. The missiles might not have landed yet. The pipelines might still be intact. The tankers might still be sailing. But the oil market has already reacted. Because markets aren't waiting for the present. They're constantly trying to price the future. And when the future suddenly looks unstable, the cost of energy becomes a reflection of that uncertainty. So the next time you see oil prices jump during a conflict, remember something unusual is happening beneath the surface. It's not just about barrels of crude. It's about fear, expectations, supply chains, financial markets, and the fragile network that keeps the global economy running. And the uncomfortable question that always lingers in the background is this. If the mere threat of war can move the price of oil so dramatically, what happens if the disruption is real? Before you go, If you found this explanation useful, please like the video and share this channel so more people can understand the hidden forces shaping the global economy.